As OPEC's economically weakest member, Venezuela was one of the organisation's strongest advocates for cuts in production in order to raise global oil prices. At the end of the first quarter, however, it has the largest production above its allocation of any OPEC member. Indeed, in the first 3 months of 2017, its output was just over 2 million barrels per day. That's some 80,000 barrels per day above its agreed ceiling. And indeed, that compares with an agreed cut of 95,000 barrels per day it agreed to in November. Venezuela's economic weakness centres on the country's huge debts, which were mostly run up between 1999 and 2013 under the presidency of Hugo Chavez, who borrowed extensively to boost the country's economic growth and to finance a series of social measures, including price subsidies for oil products and other basic commodities. The borrowing was supported by the rise in global oil prices that had occurred between 1990 and 2008, and the secondary rise that lasted from 2010 to 2014. Venezuela is highly dependent on oil. About 98% of the country's exports come from oil, which is responsible for the national company, Petroleum de Venezuela. Under Chavez, the state company was obliged to fund much of the cost of the country's social measures, depriving it of much of the cash it required to fund its own capital investment. Latterly, it's even seen some of its money needed for its current operational requirements diverted to the central government. The result of all of this is the deterioration in the state's oil sector, leading to a series of problems which the PDVSA does not have the financial resources to tackle. The most severe of these problems is a decline in the country's oil production. At the beginning of Chavez's presidency in 1999, Venezuela's production in crude oil and natural gas liquids totaled 3.5 million barrels per day. In his final year, 2013, it was 2.7 million barrels per day, and in 2016 it was down to just 2.5 million barrels per day. This year could be even lower. The absolute decline in output since 1999 conceals the fact that over the period since then, Venezuela's oil production has become more heavy and therefore less valuable. The reason for this is the country's oldest oil fields are in long-term natural decline, and these oil fields are a source of most of Venezuela's light and medium crude, whilst the newest fields by contrast are mainly the heavy and extra heavy crude varieties. The result of all of this is that Venezuela's reserves are becoming overwhelmingly heavy and extra heavy crudes. Heavy oil production has been a problem for Venezuelans for more than 2 decades. In fact, in the 1990s, Venezuela developed an oil and water emulsion from its heavy crude, known as oil-emulsion. The aim was to convert a substantial proportion of the country's heavy crude production into oil-emulsion and to have it classified as OPEC as some form of petroleum product. By doing so, the Venezuelans hope to avoid any future restrictions by OPEC on their oil production by having more and more of it classified as not being crude oil. Now, since OPEC's quotas only apply to crude oil, it was hoped this would be able to circumvent OPEC's restrictions. However, commercially, oil emulsion failed and it ceased to be produced. Many Venezuelan officials felt that OPEC's production policies favoured producers in the Persian Gulf at the expense of those outside it, and received support from the US for this point of view. There were hopes in Washington in the 1990s that Venezuela may eventually leave OPEC, which successive governments have regarded as a threat to energy security of the US. The decline in Venezuela's production, combined with the rising domestic consumption of oil, aided by the low subsidised domestic prices, has reduced the volume exports considerably. In 1999, for example, Venezuela's net exports of crude oil were 2.8 million barrels per day, and in 2016 they were only 1.9 billion barrels per day, and in fact may have been lower if it not was a severe decline in domestic consumption following 2013's severe economic crisis and the hyperinflation in Venezuela. Venezuela's main export market has traditionally been the US, but President Chavez reduced reliance on the US market, partly for ideological reasons and partly for commercial reasons. Indeed, the US in turn has been importing less crude from Venezuela in recent years as its own production has increased. Venezuela has therefore switched much more of its exports to Asia, and particularly to China. Last year, Venezuela supplied just over 5% of Chinese imports of crude, with exports of around 400,000 barrels per day. Some of these have been outright sales, but most of them has been as a repayment for debts owed to China. Recently, another oil for debt loan was signed with India, and in 2016 it exported around 470,000 barrels per day to the country, of which most was said to be the repayment of earlier debts. The repayment of debt with crude oil could prove to be a problem for Venezuela, especially if it has to reduce its own production in order to comply with OPEC's production cut agreement. Nearly 1.2 million barrels per day of the country's oil production is reported to be earmarked for the purpose of debt repayment, which is about half of the year's forecasted production. Venezuela has a number of other commitments to supply oil this year, including to the country's refining system, heavier oil allocated to joint venture partners, and oil committed under terms of supply contracts. When added together, these supply arrangements comfortably exceed Venezuela's likely production in 2017 by over 500,000 barrels per day. Part of the deficit may have to be met by imports. The PDVSA may also have to reduce deliveries to some of its regular customers. For example, one arrangement that may be cut is the arrangement to supply 18 Caribbean and Central American countries under concessionary terms with a scheme known as PetroCarib. The largest volume goes to Cuba, which receives around 50,000 barrels per day on barter terms, the other main recipients being the Dominican Republic, Jamaica and Nicaragua. Deliveries under this scheme have been falling in recent years as Venezuela has struggled to find enough crude oil from its own production to fulfill its obligations to its PetroCarib countries. The consequence of this has been that the PDVSA has to buy products from elsewhere in order to supply some of its members. Clearly, this is an unsustainable business model. What Venezuela needs desperately is investment. It had planned to be producing 6 million barrels per day by 2019, of which 4 million barrels per day is meant to come from the Orinoco Belt. However, the chances of achieving this are essentially zero. Orinoco's production at present is only 1 million barrels per day, and the PDVSA does not have the resources to develop, expand, or tap into the estimated 301 billion barrels per day of reserves that are thought to be there. In addition to providing for the production and processing of the crude, it also needs to extend the pipelines and the other infrastructure to transport and export the crude oil. In all of this, the PDVSA is considerably handicapped by the need to earmark a larger portion of its earnings to service the debts of both itself and the government. This year, their combined debts will require payments totaling $10 billion to cover the interest and the repayment of debts maturing in 2017. This has to be set against the company's likely earnings around $30 billion, and between them the government and themselves have debts totaling $71 billion. All of this means that the PDVSA must rely on foreign investment, not only for the Orinoco Belt, but also for its other upstream ventures. Here there are three significant problems that connected from the debt. Firstly, the PDVSA is behind on payments owed to existing suppliers. Secondly, foreign companies are handicapped by the economic chaos that exists within Venezuela. And finally, there is growing political opposition to the involvement of foreign oil companies in the country. A number of politicians that are opposed to the president object to the government's policy of selling shareholdings in oil-producing joint ventures to foreign companies, which the PDVSA has to do to raise money to service its debts. For example, in 2016, Rosneft paid $500 million to increase its share of another joint venture, Petromonagas, from 16.7% to 40%. The price was condemned by many opposition politicians as being too low. The PDVSA nevertheless has little choice in the matter of selling holdings in joint ventures and other assets, since it has to service those debts. In 2016, it agreed a particularly controversial arrangement with Rosneft, in which it offered a 49.9% shareholding in its US refinery subsidiary, Citgo, as collateral for a loan from the Russian company. The deal caused most alarm in the US, where, amid all the panic around the supposed interference by Moscow in US elections, several politicians expressed concern at the idea of a Russian company being able to acquire control of a large US-based oil company in the event of default by the PDVSA on the loan. The main problem, however, is a lack of diversification and Venezuela's reliance on the Orinoco for any increase in oil production, which means developing the most expensive oil fields in order to produce the crude worth the lowest value. There remains plenty of scope for reworking existing light and medium crude fields, which could reverse the decline in several of them, producing more valuable crudes at a much lower cost than in the Orinoco Belt, as well as providing more light crudes as a diluent for heavy crude oils produced elsewhere in Venezuela. The gains in output will be much less than those planned for the Orinoco Belt, but far more achievable.